Good morning, 8/23/2012. What do I have before us? I have that wonderful Dow chart. The reason why I am showing this to MMTs again, because over this last week, and today is Thursday, and through this dog day of August, and we really talked about this last Sunday when we put out some analysis, is that people needed to be selling up into the resistance areas and not to be fooled, because what has happened is in high frequency advanced technologies, there is a way that when people are not involved in the market, most hedge fund managers, as I have said, and a lot of people have not been involved in this rally. An electronic script is to walk them back up to all-time highs, and I'm showing right here on the Dow that there is a 7 to 10% correction that could come even in the face of getting QE3 from Ben Bernanke approval, that the market would have to correct 7 to 10% in the month of September. This is this side of the market, because we had ran all the way up electronically with high frequency buy scripts that walk these markets up there. That doesn't mean that the humans are in there, because 11% out of 100% of the hedge fund managers, as I said, only 11% outperformed the S&P out of 100. That means that most people have been sitting on the sideline the whole rally and missed it. And when these pricing scripts change, it's when people feel that the train has left the station. Well, remember, a program script is a buy and sell intraday range. But we start to do these reversals, and this is the Dow Jones lows right here, where this whole rally started. I'm sorry, I'll draw a horizontal trend line. So basically what I want people to know is that this low right here, where this green candle is that we would come back down and we would test this. This is on a weekly chart, but it starts with a weekly reversal, just like it does to the upside in high frequency. It starts with a weekly upside, and every time it hits support, they just walked it up. Now, on reversals, for you to have the confirmation that I am talking about, is that the put to call side ratios change. Meaning that for the last 6 weeks, the calls have paid wonderfully, and the puts are totally deflated. So there's a big mathematical imbalance. There was a big mathematical imbalance before we had this rally. That meant that the calls were so deflated and the puts were inflated when we had that correction, and we rallied them right back up. Well, guess what? The put side of the market, which is the most undervalued side of the market at these resistance levels, is where you start to get corrections. Okay? And that all the good news that may come out of the Jackson Hole meeting on the 31st, or the ECB on September 6th, or any of these major headline news events would not be good enough, because when you have, whether it's high frequency where they walk these things up, they walk them down too, and they start with weekly reversals. Beware, like we have said, it's very early. It's only the first couple of days of this, but we've been calling for the fact that the VIX, the fear indicator, is complacent, but all the good news is priced in. And when nobody wanted to be in the market, that's when they walk them higher, because they know that a lot of people were not. But then there are people that have long-term 401k holdings and whatnot. You would be taking a look at, well, what do I do here? And when you have reversals, you want to know how to take profits at the highs. We did this in calendar 2012 and called these multi-weekly resistance highs. That was your calendar 2012 reversal right back to the area. So I can show you right now that the Dow Jones is down 83 handles. It was down 91. But since we have this big bull cycle, we had this big bull run, every time that these things would make these highs and these indexes in the negative territory, they would come back and bring them in positive territory or only slightly down on the day because of the kind of rhetoric and the kind of headlines that have come out. What we look for in the major change is where that trade doesn't work anymore. Okay? And that once you start these reversals on a weekly level, you come down to the 10 week and the 20 week, yeah, you'll get support within this bull rally before you break lower. But I will tell people to be very cautious in the month of September on the Dow Jones. And it is a weekly reversal, and we've been talking about it for the last several days. There's ways to confirm it. We do have the tools that will confirm it. And that is the put to call ratio is one that a lot of people don't understand when markets are putting major bottoms in or major tops in. We do understand it very well. Therefore, we are putting out a high alert that as we move through the end of the dog days of August into the holiday in September, once we do get into that September mode or before it, that from the very high of these indexes, I'm calling for a regular pullback would be to have a good correction from this rally is to pull back 7 to 10%. Then you get all your other stimuluses in, and then you try to come back and break year-end highs. And we have a long ways to go, but we're not even in fall yet. We're at the end of the dog days of summer. And the month of September is coming. The good news has been priced in. It is time for an asset reallocation model. That would be sellers and then buyers. Sell the winners. Sell the winners. And start looking in that commodity and energy sector because that's the most beaten down side of the market. So, once again, Dow Jones update. There's your weekly reversal. You will have support levels in every bull run. Has strong support on the way down. But when you come back up, you have the same kind of reversals here. Now, let's just be coherent. This was a European reversal that took them out. They had to have a correction to come back and try to make higher highs. And they came back with the same bull trend that started here. This is a secondary bull. This is a first bear reversal, and this is a secondary one that's starting now. And we would like to see about 7 to 10% across the board on every one of these indexes because that would provide us the lower end of buying that bull again at that correction level. We could get in and then walk it up and maybe break all-time highs going into year-end. It just depends on the election. I will be covering the NASDAQ 100, NASDAQ Comp, and the S&P 500. Stay tuned for it because you're going to want to know why and when markets change. This was the Europe reversal, calendar 2012. What this kind of reversal is going to be is that we just got too overbought and that we need to have some volatility to the downside. Markets do not work just in one way. You got to have pullbacks so that you can buy those in these indexes. And you have to shake out the bull. So you shake them out. It comes down to support like it does here. And it starts back up again. We'll be monitoring it between now and calendar year end. What I'm saying is you have to have a correction pullback here in order to make higher highs within the overall bull trend. If this bull is going to continue to run, there's going to have to be some downside volatility to give you entry opportunities.